Welcome back to the Daily Crypto Deep Dive. Today's deep dive is about something that looks subtle on the surface, but quietly changes how risk is priced across the crypto market. We're talking about the recent leadership change at the U.S. Securities and Exchange Commission, why traders reacted immediately, and why assets tied closely to regulatory outcomes moved faster than the rest of the market. This is not a story about a new law, it's not a story about a court ruling, and it's definitely not a story where everything suddenly becomes friendly overnight. But it is a story about expectations, and expectations are often what move markets first. Earlier this week, it was confirmed that SEC Commissioner Caroline Crenshaw will not be continuing in her role. That single personnel change triggered an immediate reaction in one particular corner of the market, the XRP token, which has historically been among the most regulation-sensitive assets in crypto. To understand why, we need to step back and look at how regulation actually works in practice. Most people think regulation is binary. Either something is allowed or it isn't. In reality, especially in financial markets, regulation is also about enforcement posture. What gets prioritized? What gets challenged? What gets settled quietly? And what gets left alone? The Securities and Exchange Commission doesn't just enforce rules. It decides how aggressively to enforce them. And that tone matters enormously for assets that sit close to the line between innovation and legal uncertainty. What's important to understand here is how that enforcement posture shows up in the real world. It doesn't arrive as a press release saying, "We're softer now." It shows up in subtler ways. Fewer surprise actions, more willingness to settle, longer timelines, quieter negotiations, and clearer signaling about priorities. For institutional investors, those signals are everything. Funds don't need perfect clarity, but they need predictability. When enforcement feels unpredictable, capital steps back. When it feels consistent, even if strict, capital can model around it. That's why assets connected to payments, settlement, and cross-border flows are especially sensitive to tone. Their upside depends less on hype and more on integration with regulated systems, and integration only happens when legal risk is perceived as manageable rather than existential. XRP has lived under that cloud longer than almost any other major crypto. For years, it has traded with a regulatory discount baked into its price. Not because users didn't exist, not because the technology didn't work, but because uncertainty made large pools of capital cautious. So when the market sees even the possibility of a shift in enforcement tone, it reacts. The reason XRP reacts faster than most is because it sits at a crossroads between crypto-native infrastructure and traditional finance. For years, it has been pitched as a bridge asset, something designed to move value efficiently between institutions, currencies, and jurisdictions. That positioning makes it unusually dependent on regulatory comfort. A meme coin can survive in a hostile environment because it doesn't need permission to exist. A payments-focused network does. That's why this market has spent years pricing in a worst-case scenario, even during periods when usage and development continued quietly in the background. When the probability of that worst-case scenario falls, even slightly, the repricing can begin long before the headlines change. Importantly, this reaction isn't irrational. Markets are forward-looking machines. They don't wait for outcomes. They price probabilities. A change in personnel doesn't change the law, but it can change the probability of future actions. And probabilities are enough to move capital. To understand why this matters at all, it helps to be very clear about what an SEC commissioner actually does. Commissioners are not investigators, and they don't write legislation, but they play a decisive role in setting the direction of the agency. They vote on enforcement actions, approve or reject settlements, influence which cases are prioritized, and shape the tone of regulatory guidance that filters down through the organization. In practice, that means commissioners help decide whether the SEC takes a hardline, confrontational approach, or a more measured, negotiated one. For markets, that distinction is critical. A tough enforcement posture raises legal uncertainty, increases compliance costs, and discourages participation. A more pragmatic posture doesn't remove rules, but it lowers the fear that actions will be sudden, inconsistent, or punitive. That's why even a single departure can matter. Not because it rewrites policy overnight, but because it subtly shifts the balance of decision-making at the top of the regulator. This is where analysts come in. Jeff Kendrick, head of digital assets research at Standard Chartered, has repeatedly highlighted that regulatory clarity is one of the largest unlocks for assets connected to payment rails and settlement use cases. His view isn't that prices explode the moment enforcement eases, but that valuation models change once the risk premium compresses. In other words, if institutions believe the worst-case regulatory outcomes are less likely, they no longer demand as large a discount for holding exposure. That doesn't create hype-driven rallies. It creates re-rating. We've seen this kind of re-rating process before, both in crypto and in traditional markets. When regulatory uncertainty lifts, prices don't usually spike once and then move on. They grind higher as risk models adjust. In previous cycles, assets that were once viewed as legally questionable re-entered institutional portfolios slowly, first as small allocations, then as core holdings once confidence returned. That process often looks boring in real time, but powerful in hindsight. What matters is not the headline move on day one, but the sustained change in behavior over weeks and months. Tighter spreads, deeper liquidity, reduced volatility, and more consistent demand. Those are the signals analysts watch far more closely than price alone. Before we move into what analysts think and what effect this might have on price action, we are going to pause for a quick word from our sponsors. Stay with us. James Butterfill at CoinShares has echoed similar thinking. His analysis focuses on how markets price uncertainty rather than fundamentals. According to Butterfill, assets with long-standing legal overhangs tend to underperform until clarity arrives, and then outperform not because fundamentals suddenly improve, but because fear fades. That distinction is crucial. Nothing about the underlying technology changed this week. The ledger didn't suddenly become faster. Adoption didn't magically spike overnight. What changed was perception. And in financial markets, perception is often the first domino. This is also why traders didn't wait for confirmation. They positioned early. If you look at how price moved, the strength wasn't explosive. It was steady. That's a tell. When moves are driven by speculation, you tend to see sharp spikes and equally sharp retracements. When moves are driven by repositioning, you see sustained demand and shallow pullbacks. That's exactly what played out. But there's another layer to this story that's easy to miss. The reason XRP reacts so strongly to regulatory signals is because of how it sits in the market's mental map. It's often treated as a proxy for regulatory sentiment itself. When enforcement pressure rises, it underperforms. When pressure eases, it outperforms, regardless of whether the news is directly about Ripple or not. That makes it a kind of sentiment barometer. Now, analysts are careful not to overstate what this means. None of the credible research desks are calling for immediate breakouts or moonshot price targets based solely on this development. Instead, the framing is about path dependency. If enforcement becomes less aggressive over time, capital that previously avoided exposure becomes more willing to engage. Liquidity improves, volatility dampens, and price becomes more reflective of usage and adoption rather than fear. That's a slow process, but it starts with moments like this. Looking ahead, analysts are focused less on whether this turns into an immediate rally, and more on how the market behaves through inevitable stress tests. Early year pullbacks, macro headlines, and broader risk-off moments will all challenge this emerging optimism. If this market continues to find buyers during those moments, it strengthens the case that the regulatory discount is genuinely compressing. If it fails quickly, it suggests expectations move too far, too fast. That's why this story won't be resolved in a day or a week. It will be resolved in how price, liquidity, and participation behave across the first quarter. Quietly, methodically, and without fireworks. It's also worth addressing what this does not mean. It does not mean the SEC has gone away. It does not mean regulation disappears. And it certainly does not mean every crypto project suddenly benefits. Regulatory easing, if it comes at all, will likely be selective, gradual, and politically constrained. There's also the risk that the market gets ahead of itself. If expectations run too far, disappointment can follow. Analysts consistently warn that personnel changes don't equal policy changes, and enforcement frameworks remain intact regardless of who occupies individual seats. So where does that leave us? From a market perspective, today's move tells us that traders are reassessing downside risk. The regulatory discount that has weighed on this market for years may be narrowing, not disappearing, but narrowing. That alone can support higher prices without requiring new speculative narratives. From an analytical perspective, the takeaway is restraint with optimism. This is not a finish line. It's a shift in terrain. We don't usually put specific price markers into deep dives like this, because markets rarely move in straight lines, and context matters more than numbers. But given how uniquely sensitive this market is to regulatory expectations, we're comfortable putting our neck out slightly here. If the regulatory discount continues to compress through the first half of the year, not vanish, but meaningfully narrow, we think it's reasonable to expect this market to be trading materially higher by June. Under a constructive scenario, where enforcement tone remains stable and broader market conditions don't deteriorate, a move back toward the $3 region by early summer would not be unrealistic. That wouldn't require speculative mania or new narratives, just a re-rating as uncertainty fades. This isn't a prediction of a straight-line rally, and pullbacks along the way would be normal. But if this shift in expectations holds, today's reaction may later be seen as the moment the market began to price a different future. As always, this is a reasoned view, not a promise, but it's one we're comfortable standing behind. And from our perspective, the most important thing to watch next isn't price, it's behavior. Do dips continue to find buyers? Does volatility remain controlled? Does participation broaden without leverage spiraling? If those conditions hold, then today's move won't look like noise in hindsight. It will look like the first step in a longer repricing process. That's why this story matters. Not because it guarantees anything, but because it changes what the market thinks is possible. And in crypto, possibility is often the most powerful force of all. Make sure you are following the show, and as always, we will see you at the top.